Hey there, and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to be here.
So, today we've got a really important topic that's affecting a lot of landlords and tenants alike, rent increases.
Right. And it's not just about the numbers. It's also about understanding the legal limits and the timing involved.
Exactly. I mean, with so many changes happening in the market, it's crucial for both sides to know their rights and responsibilities.
Yeah, and we'll dive into some key points like how often rent can be increased, what the legal limits are in different areas, and, how to communicate those changes effectively.
Plus, we'll touch on some strategies for investors on how to navigate these potential challenges while still maintaining a good relationship with tenants.
That's right. It's all about creating a win-win situation, right?
For sure. So whether you're a seasoned investor or just starting out, you'll want to stick around for some practical tips and insights.
Let's get right into it. First up, we should probably talk about the common legal limits on rent increases.
Great idea. Let's break that down.
So, with everything happening in the economy right now, it's really crucial for those of us over 40 to understand how rent increases can impact our investments. I mean, think about retirement timelines and how inflation is eating away at our purchasing power.
Absolutely, Mike. I've been hearing a lot of people express concern about rising costs. It's not just the rent increases, but the overall economic climate. It can feel pretty overwhelming.
Right, and when we talk about rent increases, it's not just about the numbers. It's about securing your financial future. For many investors, especially those nearing retirement, stable rental income can be a lifeline.
Exactly. I've spoken to investors who have shared how they rely on that rental income to fund their retirement, and any unexpected hikes in rent can disrupt that flow.
Yeah, I remember this one investor I spoke with. He was in his early 60s, planning to retire in just a few years. He had a few rental properties, but was hit hard when his tenants received notice of a 10% rent increase. It wasn't just about the money. It was about his peace of mind.
That can really shake someone's confidence. And I can imagine how he felt, thinking about his financial security.
Exactly, and with inflation hovering around those unsettling levels, it's more pivotal than ever to understand the legal limits on rent increases. Many might not realize that there are often regulations in place that protect both tenants and landlords.
Right, and those laws can vary significantly depending on where you are. Some areas have strict caps on how much rent can increase year over year, which can provide some reassurance for investors.
Yes, and knowing these limits can help investors plan better. For example, if you're in a market with a 3% cap on annual increases, you can project your income more accurately.
And that can help with financial planning for retirement, which is so important as we get older. The last thing we want is to be caught off guard when we think we're all set.
For sure. And then there's the emotional side of things. Financial security through property isn't just about numbers. It's about feeling secure in your future.
Right, and passing that security on to family is a huge aspect too. I've heard stories of investors who are not just building wealth for themselves, but also creating a legacy for their children and grandchildren.
Absolutely. And that's a powerful motivator. Just imagine being able to transfer a property or two to your kids. It can ease their financial burdens and provide them with stability.
Yes, and I think about how this ties into current economic trends too. With the market shifting, many are looking to real estate as a more stable investment.
Exactly, and, when you've got inflation eroding the value of cash, having real estate can act like a hedge against that. Plus, it's a tangible asset, something you can see and manage.
Yes, and for many, that sense of control can be really comforting, especially in uncertain times.
Right, and it's also about timing. Understanding when to implement rent increases can maximize income without losing good tenants.
That's so true. And sometimes it's about being proactive, right? If you know your area's rental market is heating up, you might want to consider your options before the peak hits.
Exactly. And I've seen investors who've done that successfully. They've gradually increased rents to keep up with market demands, which helps them maintain their cash flow.
And it's about finding that balance, isn't it? You don't want to push your tenants out, but you also need to ensure your investment is sustainable.
Definitely. And that's where understanding your local market and knowing your tenants comes into play. Having those strong relationships can really make a difference.
I've heard stories where landlords who kept open lines of communication managed to find that balance. They could explain the need for an increase, and tenants were more understanding.
Yes, and it's those personal touches that can transform the landlord-tenant relationship into a partnership, which is invaluable for long-term success.
It really is. And for those over 40 thinking about their long-term wealth, understanding these dynamics becomes even more critical.
Totally agree. It's about building a portfolio that not only provides income now, but can also grow and sustain itself, even through market ups and downs.
And with the right strategies, it's possible to navigate these challenges and come out ahead, feeling secure about your choices.
Exactly, and that's what we're going to dive into next. Practical strategies that can help you manage rent increases effectively and build a stronger, more resilient property portfolio. So, when we're talking about rent increases, one of the first things you want to consider is the legal limits. Now, this can vary quite a bit depending on where you are.
Right, like in some places, there are strict caps on how much you can increase rent each year.
Exactly, and it's crucial to know your local laws. For instance, in California, there's a statewide rent control law that limits increases to 5% plus inflation, but it can't exceed 10% in a single year.
Wow, that's pretty specific. So if inflation's, say, 3%, you could only raise rent by 8%, right?
That's right. And knowing these limits helps you plan your investment strategy. If you're pushing the limits every year, you might risk losing tenants, which can be costly in the long run.
Yeah, turnover is such a big expense. So what's a good rule of thumb when it comes to timing rent increases?
Well, a common practice is to align your increases with lease renewals. That way, you can communicate it clearly to your tenants, and they're usually more receptive when they're already considering staying or renewing their lease.
That makes sense. And I guess it's important to also keep an eye on the market, right?
Absolutely. You want to ensure that your rent remains competitive. A good rule of thumb is to evaluate your local market every year. If similar properties are renting for significantly more, you might have room to increase. But if they're lower, you may need to hold off.
So how do you actually calculate a reasonable increase?
A helpful method is the 1% rule. This means that your monthly rent should ideally be about 1% of the property's value. For example, if your property is worth $300,000, you'd aim for a monthly rent of around $3,000.
That's a straightforward way to gauge it.
Right, and then you can adjust based on the specifics of your market. If you're in a high-demand area, you might be able to charge more, while in a slower market, you might need to offer lower rent to attract tenants.
So if you're following that 1% rule, does that mean you can increase rent by 1% as well?
Not necessarily. The 1% rule is more about setting a baseline for initial rent. When it comes to increases, it's about balancing what's legal, what the market can bear, and your expenses.
Got it. And speaking of expenses, what other factors should investors consider when thinking about rent increases?
You definitely want to look at your operating expenses. A good rule of thumb is the 50% rule. It suggests that about 50% of your rental income will go towards operating expenses, including maintenance, property management, and taxes.
So if you're bringing in $3,000 a month, you'd expect to spend about $1,500 on those expenses?
Exactly. And that leaves you with $1,500 for your mortgage and other costs. If your expenses are rising, you might need to consider that when setting rent increases.
That's a solid point. And it's also vital to keep an eye on your mortgage payments, right? If rates have gone up and you're on an adjustable rate mortgage, that could affect your cash flow too.
Yes, and that's why understanding your financing options is crucial. Fixed rate mortgages can provide more stability since your payments won't fluctuate.
So if you're planning to increase rent, you're also considering your financing and operating costs and how that all ties into your overall investment strategy.
Exactly. And don't forget about tenant relationships. If you're constantly increasing rent, it could lead to dissatisfaction, which might prompt them to look elsewhere.
Right. Building a good rapport can often lead to longer tenancies, and that's generally better for your bottom line.
Absolutely. It's all about finding that balance between maximizing your income and keeping your tenants happy.
So what about the timing of these increases? Should you consider seasonal factors?
Definitely. Many people move during the summer, so that could be a better time to implement increases, whereas winter might be tougher if people are looking to save money.
That's a good point. You want to be strategic about when you communicate these changes.
Exactly. Maybe send out notices about rent increases a couple of months before the lease expiration. That gives tenants time to consider their options.
And it shows that you're being fair and transparent, which can help maintain trust.
Right, and always be ready to explain the reasons behind the increase. If you can show how your expenses have risen or how the market has changed, that can help tenants understand.
So basically, you want to be informed, fair, and considerate.
Exactly. And remember, the goal is to build long-term wealth. If you have good tenants, keeping them is often more beneficial than constantly searching for new ones.
That's such an important takeaway. Now let's transition into some common pitfalls investors might face when it comes to rent increases.
Sure thing. One of the biggest mistakes is not doing proper research on local laws, and that can lead to legal headaches.
Yeah, that's a big one. I can see how getting that wrong could be a costly mistake.
Absolutely. Another pitfall is neglecting to consider tenant feedback. If they feel unheard, they may choose to leave, which, as we discussed, can be very costly.
And that's just the tip of the iceberg, right? There's so much more to explore about navigating rent increases and maintaining valuable relationships with tenants.
You know, Sarah, one of the biggest pitfalls I see with new investors is over-leveraging. They get really excited about a property, and they might take on too much debt without fully understanding the risks involved.
Yeah, that makes sense. When you're trying to stretch your finances, it can feel tempting to just go all in, right?
Exactly. I mean, I had a client once who bought a property in a hot market, thinking it was a surefire way to make money, but they didn't account for the fact that interest rates were rising and their mortgage payments shot up.
Ouch! That sounds stressful. What happened next?
Well, they ended up in a tight spot. The rental income wasn't enough to cover their new mortgage, and they had to dip into their savings just to keep things afloat. It really highlighted the importance of knowing your cash flow and not stretching your finances too thin.
Right. So what should someone look for to avoid that situation?
First, always calculate your cash flow before making a purchase. Look at your expected rental income versus all your expenses. And, include things like maintenance, property management fees, and potential vacancies.
That's a great point. So it's like making sure you have a safety net, right?
Exactly. And another common mistake is not screening tenants properly. I've seen investors rush to fill vacancies just to avoid losing money. But that can lead to, disastrous situations.
Like what?
I had another investor who took on a tenant without a thorough background check. Turns out the tenant had a history of late payments, and they ended up not paying rent for 3 months. The investor had to go through the eviction process, which took time and money.
That's so frustrating. How can investors do a better job at screening tenants?
Well, they should always check references, verify income, and look at credit history. It's like getting a complete picture of who you're renting to. And if something feels off during that process, trust your instincts.
Definitely, and I imagine ignoring cash flow is another big issue?
Yes, for sure. Some investors focus too much on appreciation and forget that cash flow is king. I had a friend who bought a property thinking it would skyrocket in value, but the area didn't develop as expected, and his cash flow was negative for years.
That's tough. I guess market timing can be a tricky game, right?
Absolutely. Timing the market is like trying to catch lightning in a bottle. I mean, I've seen investors wait on the sidelines for the perfect moment, only to miss out on great deals because they were being too cautious.
So what's a better approach?
A better approach is to focus on the fundamentals. Look for properties that meet your cash flow criteria, regardless of market trends. And remember, real estate is a long-term game.
Right. So it's really about being patient and not getting too caught up in what's happening in the market on a day-to-day basis.
Exactly. And then there are hidden costs that can really surprise investors. I had one client who didn't account for property taxes and insurance increases. They thought they'd have a steady cash flow, but those hidden costs crept up and started eating into their profits.
Wow, that's a tough lesson. How can someone avoid those surprises?
It's all about doing your homework. Before purchasing, research the area's tax rates and insurance costs, and don't forget to budget for repairs and maintenance. It's wise to set aside a percentage of your rental income just for those unexpected expenses.
That's a smart strategy. I think being prepared can save a lot of headaches down the line.
For sure. And I think another thing to watch for is the condition of the property itself. Sometimes investors underestimate repair costs or the time it takes to fix things.
Yeah, I can see how that could derail a plan.
Absolutely. I had an investor who bought a fixer-upper but didn't get a thorough inspection. Once they started renovations, they found significant structural issues that weren't visible at first. It turned a relatively simple project into a money pit.
That's so unfortunate. So what's the best way to avoid that kind of situation?
Always get a comprehensive inspection before finalizing a purchase. And be prepared for some flexibility in your budget for repairs, just in case things don't go as planned.
That definitely seems like a wise approach.
Yeah, and, all of these pitfalls can be avoided if investors stay informed and take a cautious approach.
Right. So it's about having a strategy in place and not letting excitement lead to hasty decisions.
Exactly. And if you ever find yourself in a tough spot, it's important to reassess and look for ways to recover. You could consider refinancing or even partnering with someone to share the financial load.
Those are great suggestions. It's really about being adaptable and learning from experiences, right?
Absolutely. Real estate investing is a journey. And, every experience, good or bad, teaches you something valuable for the future.
Well said, Mike. I think our listeners will find that really encouraging. So what should they focus on next as they move forward in their investing journey?
I'd say start by evaluating your current investments, identify any potential pitfalls, and adjust your strategy accordingly. And remember, it's always a good idea to connect with other investors or mentors who can provide insights and support.
That's a fantastic takeaway. Building a network can really make a difference, can't it?
Definitely. Having that support system can help you avoid mistakes and guide you on your path to success.
I love that. It's all about learning and growing.
Exactly, Sarah. And I think it's so important to keep those lines of communication open and continue sharing experiences. All right, so let's dive into some immediate steps that anyone can take today, no matter where you are in your investing journey.
Yeah, absolutely. One of the first things I always recommend is to really familiarize yourself with the local laws regarding rent increases.
Exactly. Each state and sometimes even individual cities have specific regulations. It's crucial to know what those limits are. You can usually find this information on your local housing authority's website, or even just a quick Google search can yield some solid results.
Right. And once you've got that down, I'd say start tracking your properties and their rental income. There are fantastic tools out there, like Zillow or Rentometer, that can help you gauge what the market is doing.
Oh, definitely. Rentometer is great for comparing your rental prices with similar properties in your area. It gives you a good snapshot of whether your rents are aligned with the market.
And don't forget about the Bigger Pockets calculator. It's a really handy tool for analyzing potential deals. You can input your expenses and projected income to see if a property is worth investing in.
Yeah, that one's a gem. It helps you see the numbers clearly, which is essential. And speaking of numbers, if you haven't already, consider joining your local multiple listing service, or MLS.
That's a good point. Being part of the MLS can give you access to a wealth of data about property sales and rental prices. It's like having a front row seat to the market.
Exactly, and it's super valuable when you're trying to decide if a rent increase is justified. You want to be informed, right?
Yes, and for those just starting out, I suggest setting a small goal. Maybe analyze just one deal a week.
That's perfect. It keeps the process manageable and helps you build confidence as you go along.
Totally. And if you're looking for inspiration, check out some books and podcasts. The book on rental property investing by Brandon Turner is a classic.
Oh, that's a must read. And for podcasts, you can't go wrong with Bigger Pockets. They cover so much ground, including rent increases and property management.
Great suggestions. And don't underestimate the power of local meetups. Connecting with fellow investors can provide insights that you won't find in books or online.
Absolutely. Networking is invaluable. You can learn from others, experiences, and maybe even find a mentor who can guide you along the way.
And speaking of mentorship, if you find someone experienced, don't hesitate to ask questions about their strategies for rent increases.
That's a great idea. Most seasoned investors are happy to share their knowledge. Just be curious and open-minded.
And remember, it's all about starting where you are. Take small, actionable steps. It doesn't have to be overwhelming.
Right. Just focus on progress, not perfection. Maybe today, Just set aside a few minutes to review your local rent laws, or check a rental price comparison tool.
Exactly. And as you build those habits, they'll snowball into something much bigger over time.
Yes, and don't forget to keep an eye on the market trends. Staying up to date can help you make timely decisions about your rental properties.
For sure. And if you're feeling a bit lost, there are plenty of online forums and groups where you can ask questions and get advice.
That's a great reminder. Being part of a community can really help you feel supported in your journey.
So, with all these tools and steps we've discussed, listeners are definitely equipped to take action.
Absolutely. You're ready to dive in and start building that wealth through real estate.
Let's keep this momentum going. There's so much more to explore in the world of property investing.
Well, that wraps up our discussion on rent increases, Sarah. I think we've highlighted some really important points today.
Absolutely, Mike. So just to recap, one key takeaway is understanding the legal limits on rent increases. It's really crucial for landlords to stay compliant, right?
Yeah, and also the timing of those increases. Knowing when to implement them can make a big difference in tenant retention and overall cash flow.
For sure. And let's not forget the importance of communication with tenants. Being upfront about potential increases can really help maintain that positive relationship.
Right, and it's always good to keep in mind the market trends. Being aware of what's happening in your area can guide your decisions effectively.
Exactly, Mike. And, at the end of the day, building wealth through real estate is a marathon, not a sprint. Staying informed and making thoughtful decisions can really pay off in the long run.
Well said, Sarah. And for those listening, if you found this episode helpful, don't forget to like and subscribe. And we'd love to hear your biggest takeaway or any questions you might have in the comments.
Yes. And if you know someone over 40 who's looking to invest in property, share this episode with them. It could really help them on their journey.
And speaking of journeys, next time we'll dive into maintenance request systems. Automating that process can save you so much time and hassle.
I'm really looking forward to that discussion, Mike. It's going to be super practical for our listeners.
Absolutely, Sarah. Thanks for the engaging conversation, and thank you to all our listeners for tuning in today.
Until next time, keep investing in your future and take care.